It is well known and well accepted that every firm operating in an industry is impacted by the factors that affect that industry or sector. For example, if there is an infrastructure sector slowdown, it might impact cement and steel companies because these companies sell mainly for infrastructure development. Likewise, when Jio entered the telecom industry, the other players were impacted because there was a huge price war. Therefore, analyzing risk at the industry level is very important when you are undertaking analysis of credit risk involved when you are lending to a specific firm in that industry. There are 4 industry-specific factors that are required to be looked into when you are looking at the analysis of an industry. Number 1, sensitivity to the business cycle. Number 2, industry or the product life cycle. Number 3, structure or characteristic of the industry. And number 4, profit potential of the industry. Every industry has different degree of sensitivity to the business cycle. Some of the industries are more sensitive to the swings in the business cycle as compared to the other industries. For example, the construction and automobile industry is immediately impacted if there is an economic slowdown, whereas the consumption of cigarettes or liquor may not go down immediately upon the swing in the business cycle. The sensitivity of the firms in an industry is determined by the sensitivity of sales, the operating leverage and the financial leverage. The industries that sell essential products are less sensitive to the business cycles as compared to those industries that sell non-essential products. The firms in an industry which has the higher operating leverage, that is, the higher proportion of fixed cost as compared to the variable cost, are more sensitive to the swings in the business cycle. For example, hospitality and airline industries, which have very high level of fixed costs. Also, higher the financial leverage of the firm, greater the sensitivity of the firm to the business cycle. We can look at industry life cycle in 4 stages: research and development, growth, maturity and decline. In the research and development or R&D phase, there is an emphasis on product creation as well as on promoting the product by highlighting the need for the product. The industry pioneer will enjoy a monopoly status at that stage. In the growth phase, once the need for the product has been established and the product is well accepted in the market, the competition will come in and the competitive pressure will start building on the product sales as well as on the product price. As the product enters the mass production stage, there will be higher level of competition and the product and the industry will enter into the maturity phase, where it is difficult for any of the players to make a super profit. The industry or the product will thereafter enter the decline phase unless there is a new innovation that takes place which extends the life cycle of the product or the industry. While explaining this, I have use the term product and the industry synonymously. But if you want to look at the product life cycle in specific, we can look at it in a different way. This is the depiction of a generalized product life cycle. There is a product in the design stage and getting introduced into the market, whereafter the profits as well as the number of units produced keeps increasing in the growth phase. Once there is a competitive turbulence in the latter stage, the product soon enters the maturity cycle. However, as the competition is more, the sales keep growing for the industry as a whole or for the product as a whole. Thereafter, once the maturity stage is there for some time, the product might decline or get into extension unless there is a life cycle extension that kicks in because of certain level of product innovation. The structure or the characteristic of the industry also determines the sensitivity of the particular firms in the industry to the business cycle. The structure and characteristics of the industry are mainly influenced by the share of the top firm or firms in that particular industry and the number of competitors in the industry. The licensing policy of the government can set up the entry barriers, which is good for the existing players. If there are low entry barriers, the existing players are always at the threat of the new competition. The pricing policies of the firm are heavily impacted by the product differentiation. Are you offering something that the others don't offer? The international competition might open up another front, or if there is a product substitute that comes up, then the current players will be heavily impacted. In different industries, we can see different nature and prospects of demand. Which are the major customers and what is the number of customers in the industry? For example, if you are in an industry where there is only a monopoly customer, that customer is likely to dictate the product as well as the specifications to you. There are different determinants of demand, and these can impact the elasticity of the demand to a very great extent. Likewise, the expected rate of growth in the demand also impacts the price as well as profitability of the firms. The cost, the efficiency and the profitability parameters in an industry could be unique. The key cost elements in an industry also have a huge impact on their growth and profitability. For example, the airline sector is immediately impacted if there is a rise in the price of the fuel. The productivity of the labor, the availability of skilled laborers heavily impacts the industry profitability. Different industries have different turnover ratios. For example, the sales to the fixed assets ratio in, let's say, hospitality is much lower than, let's say, the sales to fixed assets ratio in typical services industry like IT services. The control that the industry can exercise over cost and the selling price heavily impacts the profitability. Each industry might have different levels of gross profit, net profit and return on assets. The financial ratios are also at times industry specific. The debt to equity ratio is higher in case of infrastructure projects as compared to typically services industry. The technology and research intensiveness in each industry is very unique. In certain industries, the technology could be highly stable, whereas in other industries, the technology could be moving very, very fast. So whoever is able to acquire technology at the cheapest possible rates and can create IP out of that will be a winner in that particular industry. The winner in the industry has to keep abreast of the upcoming technology changes and should be front runner in terms of implementing that technology as well. The amount of investment that the different players make in the research and development also determines the profit potential of the industry. One of the factors that indicates how much is the adoption of new technology in that particular industry is the number of sales of the new product as compared to the number of sales of the old products. The profit potential of the industry is also determined by very many factors. We can look at Porter's model, which gives us the indicators in terms of profit potential of the industry depend on certain factors. As per Porter's model, the rivalry of the firms in the industry drives the profit potential to a very large extent. If there is a threat of new entrants in the industry, the competition is bound to be intense and there is bound to be a pressure on the profitability. So if there are low barriers to the entry, then the profit potential of the industry is less. If the industry faces threat of the substitute products, which could be cheaper, easily available, then in that case, the profit potential of the industry is bound to be less. If there are no substitute products and the industry's products have a sort of a monopoly, then in that case, the profit potential of the industry is bound to be better. The bargaining power of the buyers determines the profit potential of the industry because it directly impacts the rivalry of the firms in the industry. If the buyers have a strong bargaining power, different firms in the industry will have to compete in a cutthroat way with each other and will have to drive down the price, which means there will be huge impact on the profit potential. If the industry has a lot of bargaining power as sellers, then in that case the profit potential of the industry is bound to be better. These four key factors are important for us to understand the industry risk involved while we are lending to a particular firm in that industry. If you did like this video, please do share with your friends as well as subscribe to my channel. Thank you very much and cheers.